Bank of England cut interest rates from a 16-year high on Thursday after a narrow vote in favour from policymakers divided over whether inflation pressures had eased sufficiently. Governor Andrew Bailey, who led the 5-4 decision to lower rates by a quarter point to 5%, said the BOE's Monetary Policy Committee would move cautiously going forward.
Now, at the same time, the UK economy has been stronger in recent months, and this is very welcome too. But it does add to the risk that inflation could be higher than we expected if we cut interest rates too much or too quickly. And despite easing, services price inflation and domestic inflationary pressures do remain elevated. So we need to make sure that inflation stays low. And the best and most sustainable contribution that monetary policy can make to growth and prosperity is to ensure low and stable inflation, and an economy where people can plan for the future with confidence and in which money holds its value. And we have truly come a long way in returning inflation to target.
Thursday's decision was in line with the forecast in a Reuters poll of economists, but financial markets had only seen just over a 60% chance of a cut. Rates have been on hold for almost a full year. The longest period rates have been left unchanged at the peak of a BOE tightening cycle since 2001. And this is the first cut in rates since March 2020 at the first start of the COVID-19 pandemic. In June, the BOE voted 7-2 to keep rates on hold, and minutes of the most recent meeting showed the decision to cut rates had been finely balanced for some members, echoing the language used previously when rates were kept unchanged.